Part 1. The Minsky Moment and the Great Disintermediation. Estimated duration, 2 minutes. 00 to 030. The hook. Stability breeds instability. That is the core of the Minsky Moment, a sudden, violent collapse of asset values that follows years of reckless overconfidence. Today, March 12, 2026, that moment has arrived. JPMorgan Chase has just sent a lightning bolt through the financial system, restricting lending to private credit funds after aggressively marking down toxic software sector loans. This isn't just a market hiccup. It is the first cockroach in a room that is crawling with them. 030 to 115. The structural shift. For 50 years, we have watched a great disintermediation. Banks, once the bedrock of lending, have retreated. Their share of U.S. private lending has plummeted from 60% in 1970 to a mere 33% today. In their place, a $3.5 trillion shadow banking empire has risen. By the end of 2025, non-bank lenders were funding a staggering 86% of all leveraged loans. This isn't just a niche market anymore. It is the structural pillar of modern finance, and it is built on a foundation of sand. 115 to 2. The post-2008 vacuum. After 2008, the regulators thought they made the system safer by pushing risk off bank balance sheets. Instead, they created a vacuum. Private equity credit arms and BDCs rushed in, fueled by a decade of near-zero interest rates and a desperate search for yield. Now, the global private credit market is facing its first true full-cycle stress test, and the underwriting is being exposed for exactly what it is: extremely poor. Part 2. The Hidden Rot and the Liquidity Trap. Estimated duration, 3 minutes. 2 minutes to 3 minutes. The Hidden Rot. The Aggressive Deep Dive. Welcome to the world of mark-to-believe accounting. While public markets reprice in seconds, private loans are marked to model, often staying at full value until they hit zero. Don't believe the official default rates. The shadow default rate has quietly exploded to 6%, nearly triple what it was just a few years ago. To hide the decay, lenders are using payment in kind, or PIK, loans. Borrowers who can't pay their interest in cash simply add it to the principal. It's a toxic cycle where debt compounds to hide distress. Today, 8% of all private loans are bad PIK, and this ghost debt now consumes up to 25% of some BDC portfolios. They call it amend and pretend. We should call it a reckoning. 3 to 4. The liquidity trap and gating. The market is finally waking up to the fantasy. BDCs are trading at catastrophic discounts to their reported values. BlackRock TCP Capital is trading at nearly 46% below its net asset value. Investors are panicking, but they're finding the exit doors are locked. Blue Owl has halted redemptions. Blackstone's BCRED saw a record $3.7 billion in withdrawal requests. BlackRock's HLEND just gated its investors for the first time in history, paying out only half of what was requested. The liquidity is gone just as a $162 billion maturity wall hits this year. With rates doubled and banks like JPMorgan pulling the plug, there is nowhere left to hide. 4 to 5. The trigger and conclusion. The trigger is here. AI disruption is gutting the software sector, a sector that represents 30% of all leveraged lending. As margins erode, the reliable subscription revenue that backed these loans is vanishing. We are moving into what PIMCO calls a full-blown default cycle. The era of easy returns on opaque, leveraged loans is over. As the tide goes out, we are seeing who was swimming naked. And it turns out the entire shadow banking system has no clothes. The question isn't if the correction is coming. It's how deep it cuts before it hits your retirement account.